Hello everyone and welcome to Income Tax. My name is Tim Simand. I'll be the facilitator for this course. So this Tax 1 course will be discussing primarily federal income taxation. And in this video I'll be going through some of the concepts in Chapter 1. I encourage you to review all of the concepts, either through the PowerPoints or by reading the chapter, or preferably by both. And then I'll be going through a few of the exercises that you'll be assigned in this course throughout the term. And in this chapter I'll be going through just a few of them because we start out a little bit slower in this course and then we start ramping up and getting into more complex topics where I'll be providing more assignment support in future videos. Well, let's begin then our discussion of the fundamentals of taxation by taking a look at our tax structures. The U.S. income tax system in this country uses a progressive tax system, where the more money that a taxpayer makes, the higher will be their marginal tax rate. We'll talk about what marginal tax rate means shortly. Another tax system is a proportional tax system, where the tax rate will remain the same regardless of how much taxable income a taxpayer earns. And an example of this is your state or local sales tax. Sales tax is the same regardless of who is buying an item. And then there's the regressive tax system, which is the opposite of a progressive tax system. Here, the tax rate decreases the more a person makes, whereas the tax base increases. An example of this is our Social Security system, where once a taxpayer reaches a certain level, they stop paying taxes into the Social Security system. Average tax rate, well, there are two ways in which we determine or speak about tax rates. The average tax rate listed first is really the true tax rate that the tax rate payer is paying. That is the total tax divided by the taxable income. The other term that we use is marginal tax rates. This is a different interpretation of tax rates, and I'll go through an example of marginal tax rates. But this is determined with regard to the tax rate schedule. And, for example, a married couple will pay a marginal tax rate of 22% on their $78,951 of income. So let's take a look at a tax rate schedule and maybe make more sense of this. This is a tax rate schedule. This is found, by the way, in the appendix to your e-text. And you'll see before you on the screen here a list of tax rates that are applied against various taxable income levels. And as you can see, the more money, more taxable income that a taxpayer makes, the higher is their marginal tax rate. But what's interesting to note, and this refers to the last PowerPoint slide we just left, and that is that not all of the income is going to be taxed, for example, at 22%. So, for example, if a taxpayer earns $84,200, the only portion of their income, of that $84,200 that is taxed at that 22% tax level, is the amount of taxable income between $39,475 and $84,200. So only that segment of their income is taxed at 22%. The amount of their income between $9,700 and $39,475 is taxed at 12%. And then finally, the very first $9,700 of taxable income is taxed at 10%. And this is how we use these tables then to determine the tax obligation for a taxpayer. Another way that's acceptable for the IRS, by the IRS, is for taxpayers to use tax tables. So those tax rate schedules that I just referred to are built into these tables. And you can look up your tax obligation then based on your filing status as well as your taxable income. As I said, either method is perfectly acceptable and they get you to about the same value by the IRS. We have a basic formula that we follow to determine whether or not we have to pay a tax due with our return or if we get a tax refund. We should have an income tax formula that we use to determine whether or not we're going to get a tax refund or owe in when we file our return. We start with our income. We deduct any permitted deductions from income. That gives us our taxable income. Now we will use either the tax tables or the tax rate schedules that we just looked at to determine our tax liability. And then we'll deduct any payments we made, such as withholding from your paycheck at work, or any tax credits, which are a dollar for dollar reduction in our tax liability. And then we finally arrive at our tax refund or tax due. We will expand a little bit on this formula throughout the term, but this is the basic structure, the basic formula we'll be using. Taxpayers now use Form 1040, and there are some relatively new schedules that we use. Some taxpayers will not use any schedules, very simple returns. Some will use a 3, and others will use something in between there. It depends upon the complexity and the nature of their income and expenses and obligations. I'm just going to bring up for you this is tax forms, and this too is found in your appendix. This happens to be Appendix E in your e-book. And as you can see, well, we don't fill out forms generally in this course. We dig deeper than that. We actually study what's behind each of these line items on a tax form. But we have this Form 1040, and this is the 2019 return. We fill out the various amounts, and then we start calculating. We start the process of determining how much will be our tax obligation, our tax liability. And so the formula that I just went through is built into these forms as well. And you see page 1 and down to page 2. And then, as I said, we'd pull up any schedules or adjustments that we need to make. Again, depending upon our unique taxation circumstances. We'll discuss more about this as we go through the course. As many of you know, employees receive a Form W-2 indicating the total wage and tax that's taxable. It'll also indicate how much tax was withheld, for example, by an employer. Any interest you receive, for example, from a bank would be listed on Form 1099-INT. Another form of compensation is unemployment compensation, where you'd receive 1099-G. And for 2019, the standard deduction shown on line 9 is now $12,200 for single people, and double that, or $24,400 for married. The taxable income of up to $100,000, we are required to use those tax tables I mentioned. Otherwise, we can use their tax rate schedules for higher income levels. What's nice about the tax rate schedules is you can see how to calculate your taxable obligation because of the various tax rate levels. The tables will put you at the midpoint of what you would have calculated using the tax rate schedules. And it is true that the tax rate schedules, because you're doing the math, calculate the tax rate a little bit more precisely. But as we said earlier, either method is acceptable by the IRS. And we generally will pay, especially if you have a job, you'll pay this tax obligation throughout the years, both to the federal government and the state government. In this course, our focus is only on the federal government taxation. We'll talk a little bit about credits in Chapter 9, tax credits, for example, for education expenses and for earned income credits and for child care credits and a variety of others. When you file your tax return, taxpayers will either owe in, and that situation exists when the tax liability exceeds what you paid in during the year, or you'll receive a refund where the amount you paid in is less than the payments. For example, your withholding of taxes on your weekly or bi-weekly or monthly or whatever it happens to be pay periods, and your payment statements. Many people believe that getting a tax refund is a good thing, and that's a very reasonable thing to think. Generally, though, if we're getting a tax refund, that is, from a financial point of view, not good news, because it means that we have essentially made an interest-free loan to the IRS, and we're not receiving interest for it. They're not paying us interest. All they're doing is returning the money that was always ours. So, while it's nice to get the check from the government, that money that they're giving you was always yours. And as I said, that if you would have held the money during the year, you could have had an investment and made some money on it. But because the IRS held it, you were deprived of that opportunity. So we generally want to structure our withholdings and the way in which we calculate our taxes in a way where we generally want to pay just about what we owe. In this country, the tax authority is a body of law and regulations and precedents. And precedents speaks to case law that guides the IRS and the tax courts in the proper application of the law. So there are three types of rules, essentially, or guidance that we use. One are statutory. These are established then by Congress at the federal level. And then administrative sources, such as those by the IRS, Internal Revenue Service, and then judicial, which is case law, where tax cases are sometimes adjudicated in tax courts. Within the realm of administrative sources of tax authority, generally speaking, Treasury regulations are the most compelling, have the most strength. So in the event there's a conflict between, for example, a revenue ruling and a Treasury regulation that may apply to a certain taxpayer, the Treasury regulation would be the guidance we would use. So what we have listed before us on this slide is the various administrative sources. These are IRS sources that are listed in order of strength. So IRS notices would have the least strength. Again, this would only come up if you have, for a particular taxpayer, a tax situation where you might have conflicting guidance from the IRS. And if you take the highest form of guidance that speaks to your issue, that is to say, the guidance with this that has the greatest strength. On the judicial side, for case law, often if a taxpayer disagrees with what the IRS is telling them, or a determination made by the IRS, then the taxpayer has the right to try to resolve it with the IRS first. But if failing that, they can defer their case to a court of jurisdiction, often a tax court. Most often that is the case. Sometimes U.S. district courts, and as well as U.S. Court of Federal Claims. The tax court and district court rulings can be appealed, and of course, again, if it goes to the Supreme Court, one thing that taxpayers and everyone needs to know is that most cases that are appealed to the Supreme Court are not heard. So while a taxpayer may attempt to have the Court of Appeals ruling overturned by the Supreme Court is unlikely to do that unless, for example, there's some constitutional issue at hand. So in most cases it would not go to the Supreme Court. And they do not hear most of the cases that are appealed to that court. U.S. Court of Federal Claims rulings, they can be appealed, the U.S. Court of Appeals on the federal claims, and then on to the Supreme Court. Again, I encourage you to go through some of the other slides that are provided for you, as well as review the text. In the next video, I'll be going through some of the tax problems that you'll have in this chapter.